Hey everybody, welcome back to another episode of Compound Chronicles. We're going to go over Titan and Dolly, which is the drivers of the portfolio. We're going to also go over a margin dollar cost average system using a red light, yellow light, green light system. By the end of it, I'm going to show you kind of what the strategy looks like inside a spreadsheet that kind of keeps me having some guardrails and intact. So I kind of have a plan, and we're going to execute the plan week by week. We're going to follow along here with the video. So I made a PowerPoint showing where we're at. I also have the portfolio here with M1 Finance pulled up. This is the live portfolio. You can see right now we have $55,748 as of January 25th, 2026. $8,600 of that was deposits and contributions. But overall, on that 44,919 that we started back on November 1st, or actually more like October 31st, we're up almost $2,200. So we're up 4.58% in that time frame. So 3 months we're up over 4.5%. In the same time, the S&P 500 is up only 1.35%. When I say only, that's still pretty strong. But we like to outperform. And we're going to kind of go over the strategies that we use. So kind of just looking at the strategies themselves, you can see Dolly, the powerhouse, is up 10.28% in that same time. So 3 months we're up 10.5 just with Dolly, which is a very strong portfolio, which we'll touch base on. And then Titan's up 5.14%. So you're wondering why I'm only at 4.58% because before I started videoing, I was in things like Bitcoin, and a couple other different portfolios that I kind of cut and kind of put all my eggs in these two baskets. Again, I have about 20 years of experience doing this. I was running different battle of the bills and different strategies inside this one. But between, what we're going to see with these back tests, live testing for the last few years, and there's been around the market for almost 20 years, starting back in 2006. I said, you know what, I'm going to kind of cut everything down, make things simple, which again is kind of what made me have some time to make these videos. So this is not financial advice. I'm not a financial advisor. This is just for educational purposes only. And I kind of just want you guys to follow along to see what we're doing, see where we can take this portfolio. So please like, subscribe, and follow. Throughout, even last week, I put just an update with the portfolio. Um, I think last video I had some Bitcoin I cut out. I put that percentage into Dolly. And then just actually seeing this go, seeing Dolly up 10%. I hate to chase shiny things. But I did actually take up my allocation from 10% just last week to about 20%. Titan, I went from being almost 80, I think 5%. Now it's down to 80%. And like I said, I cut my Bitcoin position in this portfolio because I hold enough in other portfolios. I said, you know what, let's keep this clean. I just hold two of these different portfolios here and run with it that. So there's a live update, kind of where we're sitting here at almost midnight on Sunday. Let's get to the PowerPoint that I created and keep this whole thing going here. So, building my wealth systematically using Titan plus Dolly and a margin dollar cost average overlay. So, throughout these videos, you're kind of see how I'm going to incorporate margin. Just like before, we have over six figures. We have a seven-figure portfolio overall. That's $55,000. While it is a nice chunk of change, it's not going to make or break our overall net worth. Not to say this is gambling money, but I'm going to take a little bit more risk with this portfolio again to see where it takes us. If you're just starting out and you have just 55,000 total investing, please don't look at margin. Look at something just as dollar cost average. Everything we kind of go over. Maybe don't incorporate the margin end of it because again, it could get you in trouble. If this account goes into a margin call or something crazy happens, we have funds to back it up before we get liquidated. Some of you others who are following might not. If you don't know what margin call is, definitely don't do this. Do your research, learn what you're doing. Again, this is not financial advice. This is just for educational purposes and kind of just keep a live diary of what I'm doing. So let's get to the video. I want to keep this a video under 15 minutes. But the first strategy we use is Titan, the core strategy. And it's a basket of healthcare funds, utilities, consumer staples, and it's hands with bonds and gold. And about 20% of this overall portfolio is actually in leveraged funds. The rest of it is, like I said, in healthcare funds, utilities, consumer staples. So this is what 80% of the portfolio, like I showed you, is in. I might even cut this down a little bit, but the only problem is this is so tax efficient. So, whatever I make gets taxed there's about a 9% turnover annually. So, and what's nice about that, it's all short-term gains. If you don't know any of these terms, short-term, long-term gains, capital efficiency, look into it because when you start getting your portfolios bigger, you're going to want to be capital efficient, tax efficient, and make sure you're making the right moves because you can start getting six figures, seven figures, and you're getting spanked by taxes and you're underperforming. Again, sometimes it's better to just be in something simple where you're buying. You're getting a better tax treatment, with long-term capital gains, which is taxed at about 15%, versus being something like Dolly, which you're going to get spanked with whatever your income tax rate is, because pretty much all that money is going to be taxed at short-term capital gains. So, but that's the one strong thing about Titan. For one, you're going to see the returns are incredible, but the turnover rate's really low, so everything's going to be taxed for the most part at short-term capital gains, and most of that with having lower yield and like I said, just a 9% turnover rate. It's very tax efficient. So Titan's very strong. You can see from February 2010, this is using testful.io back testing. This is day to day, very accurate. Back testing. I can see from, almost 16 years ago, had you put $10,000 in, you'd be sitting right around $170,000 with an annual average return of about 19.5%. And again, the SP 500 doing really good, up about 15.5% in that same time frame. And we are having equal drawdown. So 19.4% annual return, 33% max drawdown, matching the SP 500. So, we have about a 5% alpha with a strategy if history repeats itself. But again, back testing does not show forward results. Forward results will be coming in time when we, test this in front of everybody. So it'll be interesting to see. It's kind of why I'm doing this, just to keep myself in check and kind of follow these back tests and see what we come up with. So this is use a testful.io. It's a great back tester. If you want to just back test individual ETF stocks, mutual funds, it's a great product. So that's Titan. We went over this real quick last week. Kind of going to go over it pretty quick this week. My Titan might be your, who knows what, insert your name. But, even if you don't have a Titan where you're making 20%, the SP 500 is a very strong product, and one that most of us cannot beat annually. So I get with the SP 500, get the compounding, get, a buy and hold strategy going. Again, my Titan is my buy and hold. Yours might just be the plain Jane SP 500, and that is just fine. So, Dolly. Dolly's the thing we're kind of moving more of our fund into. We are now going to be allocating about 20% as our deposits come in through M1 Finance, which is an auto trader for us. It's going to continue to build our allocation to about 20% in that Chronicle portfolio that you saw before. And it's a dual momentum strategy. So I'm going to share a couple, not mine itself, but one from MedFavor, which is a 5% from all-time high, maybe in the next video. Just kind of show you what dual momentum is. It's not the one that I run, but it's still a pretty solid one over the long haul, with still pretty minimal drawdowns, similar to what I'm running, but not quite as powerful. Rotates between risk, assets, and defensive positions monthly. And the biggest thing right you're going to see with this back test, with this shallow drawdown, so moves it safely to and, when trends break, gets you in, gets you out. Usually trends after the fact, and it kind of, you might be a little bit past after the market really switches back. But this one has been pretty good, as you can see with these back tests you're going to see. So high returns with less volatility than passive indexes. But everything has a pro and con. So kind of the con with this is high turnover rate. Portfolio visualizer, when you look at it, has about 250% turnover rate, which means any gains I get is pretty much all taxed at short term, which is an ouch. You get a nice big chunk of change of gains. Our tax bracket's about 24%. You take out our 3% in state. There's 20% of the tax is going to be skimmed right off that total. So a 20% annual return is actually knocked down to about 16% annual return. But again, you cannot ignore what you're about to see, which is the test from October 2012 to January 2026. Dolly, shallow drawdown beast. But you can see 19.9% annual return, 10.4% max drawdown at that time. In the worst year when the S&P 500 was down about almost 20%, our worst year was a 5.22% down year. So pretty strong. So, you put $10,000 in here starting October 12th, or 2012, and you have 111,000 Again, these are back tests, not forward tests, but hopefully, like you can see right now, we're up 10% in just 3 months of showing Dolly. It's a pretty strong portfolio, but again, trends are friend, and right now the trend's been pretty strong on a few things that we're allocated in. So that's Dolly, very strong portfolio. Something like I said, we're moving in about 20% in my IRA, in Nicole's IRA, and anything we kind of get a hold of now. I'm actually moved between about 40 and 50% into Dolly, which is where you should be running something like this. Tax efficient. It doesn't matter how much it makes. It's going to make that annual return, and luckily for me, I don't get hit with any of those taxes. So Dolly is definitely a tax efficient an account winner. You definitely want to have something like this in an IRA. If you can get your hands on this in your traditional IRA through anywhere you have Roths or any kind of 401ks, if you're in plans that you can get in some of these different funds, momentum strategies are definitely strong. But they have their pros and cons, and we'll get into those in videos to go. But here's like my blend right here. Through my back testing, putting these through the ringer. I should expect about an 18.5% return. And that just means with this 45,000 that we started with back in late October, early November, if we would have put that same $45,000 into the account back in 2012, that 45,000 would have compounded to a nice $424,000 as of it says 2024, but that should be 2026. So pretty strong stuff. Pretty interesting. Why 80/20 in taxable account? A lot of this we already went over. The main thing is tax efficiency matters for long-term compounding. You get hit with, if you're making something with 20, you're getting it trimmed down to about 16%. That 4% is huge. Um, Again, that's why I have Titan, which is in theory making about the same amount of annual return. But the drawdowns can get a little dicey. I can test the strategy back through the all the way up through .com actually, the bubble, and it takes a little bit of hit. It's almost a 50% drawdown, which follows the S&P 500 just like it is. It definitely holds about a 4% annual return, better than the S&P 500, even going back to 1999. But the drawdown's a little bit more sketchy, which, again, Dolly should be pretty good and well adapted for that. So, but why 80/20? Again, tax efficient with Titan. Dolly might get a little bit more higher allocation as time goes, but for right now, we're going to keep it about 80/20. And who knows, next month or 2 months from now, we might switch it around. It's all subject to change. It's what's this is all about, learning. Showing and kind of just getting that happy medium with dual momentum and a buy and hold strategy. So again, we went over this live account. I made this slideshow yesterday, so it's shown yesterday, but the same thing. $8,600 deposited, almost $2,200 in profit. We took $45,000. We grew to 55,000 between gains and contributions. We're up about 4.58 time weight return, which is not a money weight, it's a time weight. So, that's 4.58% on those two strategies. We're doing pretty good. And then Titan right now, I want to be at 80/20. Titan's about 85% and Dolly's still right around 15%. So, by next video with a few more contributions, we should be, getting this closer to 80/20. But for right now, we're still sitting around our 85/15, which is the last time we kind of did a rebalance. So, but it's pretty good. Again, 85 days doing the system, and we're up a nice 4.5%. 10% coming just from Dolly itself. But again, it's down a little bit because Dolly is a smaller allocation. It was like 10% just a few weeks ago. We're up to 20 now. So, but what I have started in the last week is figuring out some kind of strategy to incorporate to keep us just some guardrails for this the margin we're going to be using with M1 Finance. So. The margin traffic light system, which we're going to touch on today. I'm going to show you how the spreadsheet looks like in person. But it's going to keep me in line. Everything's automatic for me with the spreadsheet. It's going to tell me green light to go, yellow light to slow down, and red light to stop. And then it's going to kind of show you. So the margin dollar cost average strategy went over last week, $265. Don't ask random number, but it's about a 6-to-1 ratio. So I'm putting about 265 every Tuesday. After this video, I'm actually going to go ahead and actually do that $50 transfer. I do that on the weekend, so Monday it's going to go into effect. This $50 will get put in. So for every 265, I put about $50 in, which is close to a 6-to-1 ratio. Margin is going to be capped at 10% of portfolio value. So it's a hard stop. When I hit 10% of my margin used, I'm going to stop putting anything in. I'm going to continue doing my $265 deposits and get myself to stay in a green. And then, kind of just slow down my margin usage until we get back into 10% or less. So, and M1 Finance, we have a promotional 12-month rate of 4.15%. Without that promotional rate, it's right around 5.5, maybe 5.65%. So we're significantly lower than where we're at if we didn't have this promotional rate. But even if that rate wasn't there, I'm going to still take that spread of even say a 6% spread, or 6% rate, on something I'm hoping to make about 18% on. I'll take that 12% any day of the week. So current margin usage, we're using 500, which is about 2.49% of our margin. System prevents over leveraging through zone base, which is what we're going to touch on in the next slide. So this isn't about maximum leverage. If I wanted to do that, I'd be using 50, 60% of my margin usage. It's just to kind of get a little bit of a bonus out of the strategy. Again, I was looking to get into real estate. The only thing is I don't know about real estate. I do have 20 years with investing, so why not use my knowledge and some leverage, with some of these with something like margin where I can get actually I can't even get a second mortgage for less than 4.5%. I think right now for me to get a second mortgage for 15 years is about 5.5 to 6% at your credit unions, let alone if you go to the big banks that are closer to 6.5 or 7. So if I get a rate this way, and I think I can make more money investing just with what I've seen the last 20 years than I can with real estate. Less headaches, more liquid. That's kind of why I'm looking at this margin a little bit more because I was looking to leverage with getting some banknotes and getting some real estate, but I don't want to deal with the hassle. So we're going to try this little system here, see how it works, and go from there. So this traffic light system, this is actually a screenshot of the spreadsheet we're going to take a look at. But it's going to tell me, right here, the current zone's green. So pretty much anytime I'm between 0 and 10% of my margin use, which right here shows you 2.5% with using $500. And again, our portfolio is at 55,763. I get the green light to go. So every week I'm going to put that 6-to-1 ratio, whether it's me, $265 to put 50 in, and me putting 300 and say $30, and putting $25 in. I'm going to keep that as long as we're green. Whenever I put my weekly in, I'm going to match with about a 6-to-1 margin thing. As long as we're in the green. Once we get the yellow, I'm gonna pause and right here, pause new margin. So no more margin. I'm gonna keep paying myself that 265 into the brokerage account, but I'm not gonna pay myself out of the margin account. So when we get between 10 and 15%, we're just gonna slow our roll. Markets continue to go up, we'll eventually be able to start, putting some more of our margin into our brokerage account, and kind of go from here. But when we get to the orange, we're going to slowly, instead of putting that 265 into our brokerage account, we're going to put that straight into our margin balance and try to get that back into the yellow and green. So if we hit the 15 to 25%, margin usage, we're going to slow our roll definitely, and we're going to start paying it back at 265 straight to our margin loan, and just stop all contribution to the brokerage. And then the red zone, again, this is a $55,000 account, fairly small for our net worth. So if we have to, again, that's why I can do margin. And hopefully, if you're going to follow along and do it yourself, you have means if you do get in a tight situation, where your margin gets a little bit heavier, where your 25, my 25 might be your 50. But when you get to this red zone, you might have to take a little extra precautions and double up payments. Find money somewhere that you know you should have if you're going to do something like this, and pay down and get out of this red territory, which is about 25% of margin usage. So we'll see where it takes us. But again, we like to stay in the green or yellow. Yellow is good too. It just means we can't use any more margin. Orange, we can't pay ourselves. We got to start paying the loan back. And when we get to red, we got to take some, non-emergency funds, hopefully not use your emergency funds to pay down loan debt. Emergencies are for emergencies, and to me, using margin, you shouldn't be using it if you don't have other money to pay back with other than emergency fund, because this isn't what we're doing with this strategy here. So that is that. So right now, like we went over current status safely in the green. System operating normally. We got $500 in margin, which after we get off this video, will be 550. Currently with that 500, we're about 2.49% margin usage. and our margin health is at 98%. So, in theory, if everything goes without our contributing, markets kind of stay right around where we're at. In about 211 days with our weekly deposits, we should be getting into that yellow territory where we might slow down a little bit. So, it's a dollar cost average campaign. This is a margin overlay using dollar cost averaging. It's not one of those ones that we want to max this out right away. We kind of want to get in there gradually. We get a pullback. It'd be nice if we can continue to add our deposits and kind of dollar cost average within the markets as they ebb and flow through the systems like they take a breath. So that's the way I look at it. Markets go up, markets go down. Just like we breathe, the markets do too. So we got to be able to breathe with it. And I think with the system, we should be pretty good to do that with. So, why the system works? Maybe not this exact system, but any kind of dollar cost averaging system, automatic system. One of my favorite books, Automatic Millionaire, teaches you. If you can make everything automatic, get the money in there, let it go to work for you, and it removes emotions. The system tells me exactly what to do. So whether that's your dollar cost average system, whether it's my dollar cost averaging margins system, if you have anything that kind of removes anything you can use with guardrails that tell you what to do, be more mechanical, you'll be better off. Forces discipline, no impulsive decisions during volatility, caps downside risk, can never accidentally over leverage. So, you follow that system, you get to 25%, you're still far away from a margin, um, a, um, a liquidation. You pay that back with 25% is nothing in the grand scheme of things, but it's my red light to stop and pay it back. So we don't want to get in any kind of margin trouble. So we're going to start early to kind of intervene and take it down. So accelerates compound an extra $50 a week. That's $2,600 a year in buying power. And if you continue to grow it, maybe you can get this up even more and keep it going. So built-in safeguards, automatic pay down protocols if market drops. You kind of have the math is so $50 a week, 52, like we already went over $2,600. The cost at a 4.15%. So if we had that $2,600 on day one after 365 days, that $2,600 in investing power that we got would cost about $108. So we know if we get about 18%, you subtract that 4.5% from that 18 percent. So let's just say you get a 14% rate. That's about $360 we're making after you take that $108 off of we're paying in interest. So almost over $350 on $2,600 in borrowed money. Again, that's with the $108 removed. That's not too bad of a return. So we're going to take that. We're going to see if we can make that spread work and continue to make compounding money with it. So important about these back tests. So kind of getting back to the back tests I showed you. They were both, one was from Testful.io and the other one's from Portfolio Visualizer. It is good data. I mean, I like those two platforms. Portfolio Visualizer has been around forever. Testful.io has been around for about a year or two now. Every time I go on, it's getting pretty strong. But his backtest data and his theoretical performance based on historical data. Past performances does not guarantee future results. These backtests do not include margin usage. So, for better or worse, that 18% technically, if you add margin to it, will be drastically more. Depends on how much margin we use, but also a 30% drawdown or 10% drawdown. In theory, since we're using margin on it on the bigger picture will actually be a little bit deeper. So your time weighted will still be the same, but since you're using margin, technically you'll be getting more returns when it's good. You're going to be getting a little bit deeper of a drawdown when times are a little bit more hard on us. So base strategy only. Real world trading includes slippage fees, spreads, and tax implications. And again, I should have highlighted this because tax implications are huge. Again, that's why I'm only running about 20% allocation Dolly, even though I think it's a more superior model. I just don't, I can't really eat those taxes right now, even in a $55,000 account. So I like to be tax efficient and smart. So you got to understand this. That's for you to kind of do some more research for me to touch on later. So market conditions change. Historical patterns may not repeat. So we already went over that. Backtesting do not show future results. Your results will vary based on timing, execution, and market conditions. I use backtest to validate historical resilience. I track my actual live test, actual live results going forward, which I showed you today is an actual screen of my own one of portfolios. Kind of just show you these aren't screenshots; it's the real deal. So, critical disclaimer: this is not financial advice. It's educational content showing what I'm doing with my own money. So this is not financial advice. Do your own research. Understand your risk tolerance. Consult a qualified financial advisor before making investment choices. I'm documenting my journey, not telling you what to do. So we all need to know that. Again, just kind of something that if you're a nerd like me and like investing, it's going to be kind of a cool little test we're doing. So. With that, compound growth but discipline equals results. Building wealth systematically 1 week at a time. The next video we're going to make, it's going to be my monthly update. So next Friday is going to be the end of the month. I'll do an update like we just did, see where we're at for the last three or so months, and then it's actually the last trading day. I'm going to populate my Dolly numbers and see what we got to pull, and then that night for the following day, trading day, I put an order in through M1 Finance. I'll show you kind of how I do that, and I'll show you what Dolly the signal is going to be, and kind of go from there. So again, please subscribe, and join. Even this week when I made a change to the portfolio with Dolly, made it a little bit higher. I got rid of my Bitcoin. I made just a little announcement in the live chat area in the YouTube channel. So kind of cool. Again, I kind of want to make it a little community where we all talk, have questions, we can do like a little Q&A and stuff like that. So let's build a little community. It's the second video. I think we're gonna do okay. The first video, for what it was worth, was got a few looks. No likes, no subscribers. So hopefully in time that changes once the algorithms hopefully pick up on this. But oh, you know what? Let's go to the spreadsheet. By now, yeah, M1 Finance locked me out. That was the way, but okay, here's the overview. I'm kind of building out the spreadsheet for the overall portfolio. A lot of stuff we already saw, 2.49% margin. I'm actually starting a year-to-date performance over here. What else can we go over? I did want to go over the stoplight. So this is kind of the stoplight I showed you. Again, is what's nice for me is it keeps me guardrailed in. These are all populated. Everything has formulas and kind of keeps me in track. So I'm not saying you want to use this, but if you're doing something similar, get yourself a spreadsheet and kind of get yourself something to follow. Make something a role base. Role base keeps everybody in line, at least for myself and a lot of other traders, investors that I know. I think what taught me to do stuff like this was doing options. Options, I like to have a trading plan, something to follow. This passive investing is a little bit easier, but it's still nice to have some sort of guardrail, some kind of mechanical thing. Again, I like my deposits going in automatically. I like to show the signal here automatically, and pretty much just I'm a nerd with all these numbers. I like to kind of watch everything. So the more I can put in here, the more I will. So just again, I'm building this out for viewer content, and I hope everybody appreciates it. Thank you for watching, and I'll see you guys in the upcoming videos.